Hey everyone, what is the Fed dot plot? What does it mean and how does it affect interest rates? Let's dig into it. So the Fed dot plot is a graph where the federal FOMC team members predict where they believe the federal funds interest rate will be over the course of the next few months to few years. At this moment, that same team is predicting that the federal funds rate will have one more 25 basis point hike upcoming in May, and that we will have no rate cuts for the rest of the year, and that rate cuts won't start until January of 2024. However, when you look at the CME futures index, the CME futures index is basically interest rate traders' predictions. They believe that we will see interest rate cuts start in the middle of this year and that we will end at a final benchmark rate of 4.25. So the Fed believes 5.25, but interest rate traders believe 4.25, 100 basis point difference. So who's right, who's wrong, and how are they thinking? Again, let's go into that a little bit more. So the Fed really only looks at two things at this moment. They may look at more, but in my opinion, they're only looking at two. One, CPI, which is still at 6%, even though we've discussed in the past it's going to be coming down. It'll come down on the next one on April 12th. It'll come down again in May, and it'll come down every single month for the next few months. But will it come down fast enough? That's going to be the key. And the second thing they look at is jobs. Well, the jobs report came in today. It came in strong. Unemployment is still exceptionally low. This gives the Fed all the ammo that they need, that they believe the economy is still going strong. So are they wrong? And let's go into what interest raters think and how they're believing. First and foremost, the US 10-year to 2-year Treasury curve. Right now it's inverted. Over the course of the past 3 months, it's been the most inverted Treasury curve in the history of the United States. The reason why this is important is this curve usually signals that a recession is looming. So it's very important that we're seeing this, that again, if a recession's looming, usually when that happens, the Fed drops rates to help stimulate the economy. So are the traders right with that? In addition, we're going to see a massive liquidity crunch right now because we've seen a lot of the banking collapses. Why the banking's collapsed? Because interest rates have gone up so high so quickly that all of these long-durated bonds are pretty much worthless, or only worth 50 cents on the dollar at this moment. So all of these banks are basically losing money each and every single month. So this is what's going on in the mind of an interest rate trader. All of that will affect, real estate. It affects commercial real estate. They believe that that recession will come in Q3 and in Q4, which will then signal to the Fed that they must drop interest rates instead of keeping them high. So who's right? Who's wrong? Let me know your thoughts.